I think the issue begins with what you're investing and how you're investing. If you're investing lump sums, ETFs are a wonderful thing to consider. If you're investing $200 a month, ETFs are a lousy idea because you pay commissions each on that $200, and which you wouldn't have to pay on a no-load mutual fund. Also, if your bent is active management, ETFs are not for you because active management is part of the mutual fund world. And the argument, the John Bogle argument, that indexing beats active management all the time, when you look at the big picture, is just bunk. Active management beats indexing regularly, and Dan has his readers in such funds. That said, ETFs open a lot of doors to you that mutual funds can't open. Commodities are a good example, and physical gold is another example. Niche markets. The ETF structure is very economical, and therefore it's very easy for a sponsor firm to launch an ETF compared to a mutual fund. Mutual fund has a much bigger and more expensive infrastructure.
I can't believe that I'm going to now defend Jack Bogle because he and I are like this, but Jack Bogle is right when you look at the broad universe of mutual funds when he says that active management doesn't perform as well as indexing. And let's get one thing clear. Every time you hear the word ETF, think index. And every time you hear the word ETF, think index. ETFs are index funds. The thing is, Bogle is right when he looks at the broad universe. But I personally don't look at the broad universe. I look for particular good active managers running funds which typically have lower than average expense ratios. One reason that so many Vanguard actively managed funds outperform comparable indexes is because their expense ratios are very low. The only advantage indexing really has at the end of the day, the only advantage indexing has is lower expense ratios. When you have this great unwashed field of active mutual funds with expense ratios running 1.5%, 2% versus an index with a 20 or 30 basis point expense ratio, that's a big hurdle to get over. But for instance, at Vanguard, a lot of Fidelity funds have pretty low expense ratios, so the headwind is pretty minor. So I disagree. I agree with Jack on the universe, but I disagree that you can't find good active managers because we've been doing it for years. I've been doing it for years in the newsletter, and we've outperformed Mr. Bogle's vaunted 500 index. So
that's right. Any follow-up on that for you, Tim?
No. The Bogle's argument is that indexing is going to beat 80% of active managers, and you can't predict who the 20% are going to be who are going to outperform. And that's just silly. You can predict at least some of those repeat performers. There is a phenomenon out there called human talent, and it's not exclusive to Vanguard. Dodge & Cox family has managed to do it. Capital Research and Management in Los Angeles has managed to do it. Lots of very successful mutual fund managers. Chris Davis. So if you want active management, and in my personal portfolio, I own mutual funds because I do want active management in certain areas. The mutual fund's the way to go. You cannot get them in ETFs, and you don't want to get them in ETFs. I'm not an advocate of actively managed ETFs. I think that's intellectually flawed. But the weakness is sometimes, there are lots of ETFs that represent certain marketplaces that active management just beats. One of them is emerging markets.
I was surprised that Mike asked us originally. We were not prepped on these questions. I thought his first question was going to be, what do you think is going to happen in the market in the next few months? And I was going to tell you this. I think what's going to happen is there are going to be a lot of investors who get in a lot of trouble with ETFs. The industry has grown very rapidly, and there are going to be. Did I preempt your question? Were you going to ask that? There are some very dangerous tools being provided to investors these days, particularly the inverse and the 2x and 3x type ETFs that leverage the movement of a particular index These are trading tools, and investors, as opposed to traders who try to use them, are going to be very, very disappointed. They're not going to get what they think they're getting. And a very quick example, if you had owned a perfectly correlated inverse S&P 500 ETF for the last 5 years, the S&P dropped 11%. If that inverse ETF had absolutely mimicked on the opposite side every move monthly of the S&P, one would have expected that if the S&P was down 11, this ETF would have been up 11. It actually was up 3. And if you had had a 2x, a negative 2x ETF, with the S&P down 11, you would have expected to have a 22% gain. The negative 2x ETF would have lost 0.3%. You cannot use these inverse ETFs and these leveraged ETFs and get the full benefit in any kind of a market where you've got a seesawing market. If the market went one direction in a straight line, yes, it would work. But the minute you start seesawing, they lose a lot of their promise.
Yeah, Tim, I know you've written about those very funds and that phenomenon. Do you want to build on that?
That's right. We happen to own, at ETF Insider, we own a leveraged inverse fund right now. It's called Ultra Short 20-plus year Treasury ProShares, ticker symbol TBT. We do it for 2 reasons. One, there is no unleveraged bear fund for treasuries. And 2, treasuries are the lowest volatility security that there is. And as Dan was suggesting, compounding error grows with volatility. So the compounding error, or to say it differently, the reliability of the bear market treasury fund has been very, very good. If I were going to use leverage, that's one that I could recommend to you unreservedly. It's worth bearing in mind that the ETF companies will tell you that their ideal customer owns their funds for one day, one trading day. They do not recommend them for more than one day, and they will be happy to tell you every negative reason, mostly to satisfy the SEC. The SEC hates these things and probably eventually will make them illegal.
One second, Dan.
Yeah.
Tim, first, do you share Dan's opinion that these things are dangerous and can be pretty bad for investors if used improperly?
Well, they are, I think, and I've written about this at some considerable length. I'm doing a real-world experiment at MSN. At MSN Money, I operate a model ETF portfolio. I've been doing it for more than 5 years. And since the beginning of this year, that portfolio has had its equity allocation strictly in levered funds. And what I've done, therefore, is freed up capital to put into bonds. The levered funds, instead of, say, owning 20% of large cap domestic stocks, I own 10% of a 2 times large cap domestic stock. And then I take that 10% in the capital and put it over here in bonds. And what has happened so far is that my tracking error has been modest.
Anybody out there remember the 130-30 funds? They've done a horrible job. The 130-30 funds were funds that were leveraging up 30% so that they could take that additional 30 and use it to try to reduce volatility. And they have, I think, 2-1 have underperformed the market, which was their benchmark. So that's sort of a similar strategy. I would just say that Tim's probably a little smarter than the average bear or bull, but these things are really dangerous. Take a look at the double short REIT ETF, which moves like a bouncing ball day to day. It's amazing. It can move 7-12% in a day. Just incredible.